Due to market volatility, and in part to the global financial crisis, we have witnessed Australian investors flock to cash and cash-like investments in an effort to protect their portfolio from losses. While the security of cash has its temptations, it needs to be weighed against the potentially costly mistake of missing out on capital growth. It is true that an investment in cash can minimise market risk, but if you take a look at the bigger picture, it's clear that cash has some serious shortcomings as a long-term investment. Let's start by looking at a traditional risk and return chart which illustrates the relationship between risk and return across various asset classes. Lower risk assets like cash are likely to deliver lower returns, but your capital investment will be more stable with fewer price fluctuations or volatility. Conversely, higher risk assets such as equities come with a higher potential for return, but the road you may take may be inherent with volatility. Put simply, whilst you may sleep soundly with cash, you may possibly miss out on superior long-term returns, which in time will take a heavy toll on your investment portfolio and potentially your retirement lifestyle. And to consider what you're missing out on from a monetary perspective, look at this graph, which examines the returns over the last 15 years from an investment in cash versus an investment directly in the Australian share market. If you had invested $100,000 in the beginning of 1995 in cash, today that investment will be valued at just under $250,000. But if you had invested that same $100,000 in the Australian share market for the period ending 30 June 2011, your investment is valued at $487,600. That's a difference of just under $240,000. This is more impressive as the period includes the global financial crisis and saw returns of the Australian share market fall quite dramatically. Shares deliver capital growth, which reflects the rise and fall in the value of the underlying companies over time. Cash doesn't give you your capital growth, and in fact, your capital can erode over time due to inflation risk. Tax effectiveness is another big difference between cash and investing in Australian shares. Investors can often become focused on pure performance numbers and overlook the tax effectiveness of Australian shares. This simplified example shows the after-tax difference of receiving $500 worth of dividends from an Australian share fund compared to the same amount of interest from a term deposit with an assumed interest rate of 5%. With no franking credits to offset the income, the after-tax interest sits at $267.50. Compare that to the same earnings from a share portfolio, but combine it with franking credits and you'll receive after-tax income totaling $382.15. And remember, you still receive the tax benefit even if you reinvest your dividends. One of the trends we've witnessed time and again is when investors chase the best performing asset class to try and get the best returns. This table shows the annual performance of each of the major asset classes for the past 16 years. You can see that there does not seem to be any advantage in chasing the best performing asset class, as generally this year's best performer may not be next year's. It's also worth noting from this chart that there have been only 2 occasions in the last 16 years when shares, including listed property, were not the best performing asset class. This graph shows that cash has not outperformed other asset classes for any of these 1-year periods. Missing out on capital growth means that you may risk your retirement running out before you yourself run out of puff. The retirement savings gap is of serious concern. This is the shortfall in national savings, which currently estimates that each one of us needs on average a further $87,900 to retire on. For clients without sufficient savings, there are really only 2 options. 1, save more before retirement, a truly difficult task for most Australians. Or 2, introduce more growth assets into your superannuation savings away from cash. There are products available that can provide both the income and the capital growth you need to ensure your retirement lifestyle matches what you had in mind. We always recommend that you discuss your individual requirements with a qualified financial advisor. Every situation is unique, and it's important that you receive specific financial advice tailored to your individual needs and circumstances.